Hey everyone, welcome back. FinTech here. Today to talk about 401ks, specifically what a 401k is, the difference between a Roth 401k and a traditional 401k, as well as what you can do to maximize your use of your 401k to grow your net worth. Let's just jump in right off the bat and define what a 401k is. A 401k plan gets its name from section 401 subsection K of the Internal Revenue Code, which was created by the Revenue Act of 1978. Before 401ks, the way most people saved for retirement was through a pension provided by their company. But after a slight modification to the act in 1981, 401ks exploded during the 80s, quickly becoming the primary source of most people's retirement savings. Now you could have a tax law professional dive in and explain exactly what this act shows, but here's a simple definition. A 401k is a retirement plan offered by an employer. Its employees can then contribute to that plan, and employers will sometimes match some percentage of those contributions. The employee can then invest these contributions into a selection of investments which have been pre-selected by the employer. So now that we have the basic definition out of the way, let's focus on what you need to know about 401ks. The first thing you need to decide is what kind of 401k you're going to invest in. A Roth 401k or a traditional 401k. Now before we continue, I'm going to ask you to please hit the like button. The reason is likes and comments count as engagement for the YouTube algorithm, and it causes them to push this video out to a wider audience. The two most common types of 401k are a Roth 401k and a traditional 401k. Now, not all employers who offer a traditional 401k also offer a Roth option, but they are gaining in popularity. This is especially good news for those of us who are younger in our 20s and early 30s, because the Roth 401k is actually going to provide more value to us than to older employees. So first, let's list out the similarities between a Roth 401k and a traditional 401k. Both have the same contribution limit of $19,500 if you're under the age of 50, or $26,000 if you're over the age of 50. These are increases from $19,000 and $25,000 in 2019. Additionally, because your employer is allowed to contribute to the fund, the maximum that can be contributed between you and your employer combined is $57,000 if you're under the age of 50 and $63,500 if you're over the age of 50. Both Roth 401ks and traditional 401ks are administered under the same rules with your employer. They both also let you invest in the same types of investments, which are again defined by your employer. The only actual difference between a Roth 401k and a traditional 401k is in how they are taxed. For a traditional 401k, your contributions are tax deductible, meaning that you remove these contributions from your total income while calculating your taxes for the year. This saves you money on taxes this year, but in the future when you pull money out of your 401k, you have to pay income tax on all that money then. In a Roth 401k, on the other hand, all of your contributions are taxed up front. But later on down the line, when you pull money out, both your contributions as well as any earnings on those contributions are completely tax-free. In general, the earlier you are in your career, the better an option the Roth 401k is than the traditional. This is because if you are taxed now at your current income levels, chances are this is going to be less than if you're taxed after you retire. Basically, when deciding between the traditional and the Roth option, you just have to ask yourself, will I be in a higher tax bracket this year or when I retire? I found this calculator on AARP's website, which shows this pretty clearly. We can see here that if we put in an age of 25, put in an income of $50,000, and then fill in the rest of this information. If we set the tax rate for this year and the tax rate in retirement to the same amount, then both traditional and 401k end up providing the same value once you pull the money out. If, however, I bump up the tax rate after retirement, we can see that suddenly the Roth option is a better idea. If I then lower the taxes that I would face after retirement, suddenly the traditional becomes a better idea. This makes it really easy because basically the only variable you have to consider is whether or not you'll be in a higher tax bracket then versus now. Now, in my case specifically, because I'm still fairly young in my career, I use a Roth 401k. By contributing to a Roth 401k while you are still young, compound interest can work in your favor to greatly grow your investment over time. And all of this growth is completely tax-free. Additionally, for both types of plans, many employers offer an employer match. So let's say you contribute 6% of your income to your 401k each year. Your employer would then also contribute 6%. This is instantly a guaranteed 100% return on investment. So at this point, let's say you've picked out which type of 401k you want to invest in, and you're contributing some percent of your paycheck to that every month. So now that you're contributing, what do you invest the money in? Now, like I mentioned earlier, what you're allowed to invest in a 401k is defined by your employer. Some plans have better options than others. In general, I would try to find a low-cost fund that generally tracks the stock market for my investments. This is because most studies have shown that actively managed funds don't actually outperform the general stock market when you account for the fees that those funds charge. Ideally, I would just invest all the money into an ETF which tracks an index, but that might not be available to you. If that isn't available to you, a decent option is just selecting a retirement date fund. These are funds which are automatically balanced based on how close you are to retirement. So for example, if you're 20 years old, you might be 90% invested in stocks and 10% invested in bonds. If you're 50 years old, it might be 50% stocks and 50% bonds. And if you're 70 years old, it might be 80% bonds and only 20% stocks. The goal is that the closer you get to retirement, the less risky your investments become, so you'll have guaranteed money by the time you retire. The biggest problem with these plans is they can sometimes have high maintenance fees, which will really hurt your performance over time. Because all 401k plans have different investment options, the best I can really do is offer general advice. What I would do is invest any money that I'm not going to need for at least 10 years into stocks to try to get as high a return as possible. The sooner I need that money, the less risky I'm going to be, and I'm going to move some of that investment over to bonds. So for example, if I didn't need the money for 20 years, I would be 100% in stocks. But if I needed the money in 5 years, I would probably keep a little bit of the money in stocks, but a lot more of it in bonds. If I needed the money in 6 months, I wouldn't have any of it in stocks, and it would all be in a safe investment like a treasury bond. You can use a financial planner to run these calculations for you, but there are also a lot of really good calculators online that will automatically tell you what percent you should allocate to stocks versus bonds using modern portfolio theory. Modern portfolio theory is just a mathematical theory used to assign how much risk an investor should take on based on how soon they need the money. The next area we need to talk about is how to withdraw money from your 401k. With a 401k plan, you can't just withdraw money whenever you want. If you withdraw from your account before you are 59 and a half years old, there are penalties and fees associated with withdrawing money early from your 401k account. For example, if you're investing in a traditional 401k, you have to pay income taxes on the entire amount of money that you pull out of the plan. If you're investing in a Roth 401k, you only have to pay taxes on the earnings that you pull out. In addition to this, if you withdraw the money before you're 59 and a half years old, there's a 10% fee which is tacked on. Furthermore, you can't just pull money out unless there is a triggering event which allows you to pull the money out. Now, there's a whole range of events which qualify for this. An employee could retire or leave their job. An employee could die or become disabled. They could reach 59 and a half years old. The plan could be terminated, or they could meet certain hardships which the plan defines. Now, in general, withdrawing money early from your 401k plan is a really dangerous option to go with. Because not only are you losing out on your potential investment, you're also losing out on around half the money because of the income taxes and the fees you pay for withdrawing the money early. Now, I would definitely talk to a tax professional, but there can actually be benefits to taking out a loan against your 401k rather than withdrawing money. One advantage is the loan you take out doesn't consider your credit score, so if you don't have a good credit score, you can still get a loan at around 6.5% to 7.5% against your 401k. Additionally, you wouldn't pay any of the income taxes or fees. That being said, I would only ever do this in an extreme emergency. This would honestly be the option of last resort. I would never just pull this out to go on a vacation or to impress people with a fancy car. Now, these early withdrawal rules have actually been modified a little bit for 2020 due to the CARES Act. If you have been negatively impacted by the illness, which may or may not get your video shadow banned by mentioning on YouTube, so I'm just going to say illness, you can withdraw up to $100,000 early from your 401k without paying that 10% penalty. Additionally, you get 3 years over which to pay the income taxes on the amount you withdraw versus the usual 1 year. But still, what qualifies as a hardship is still defined by whatever your employer specified in the plan. Now, this all applies to withdrawals that are happening before retirement age. But after retirement age, the process changes a little bit. If you withdraw money after 59 and a half, you don't have to pay any kind of early withdrawal penalty. Additionally, once you reach age 72, you're actually required to take required minimum distributions. This means you have to pull a certain amount of your 401k out every single year. Now, there's no simple rule which says what your required minimum distributions is, but there is an IRS table where you can look it up. I can link to that in the description. Why the IRS prefers to look things up in a table rather than writing an equation is a little bit beyond me, but one thing that is good to note is required minimum distributions are suspended at least for 2020. The last thing to consider when talking about 401ks is how they stack up to other potential retirement options. If I had to go over the order in which I would rank retirement accounts, I would say the first thing I would take is whatever employer match you get in your 401k, because this is a guaranteed 100% return on investment. The next area I would contribute to would be to an IRA. The reason for this is you can withdraw money from your IRA without paying an early withdrawal penalty, and you also don't need to demonstrate a financial hardship like you do with the 401k. Only after maxing out my IRA account would I then go back to contributing to my 401k and try to max that out. The 401k and the IRA provide basically the same benefits. The IRA is just a little bit more flexible in what money you're allowed to withdraw, so it places a little bit higher than the 401k in my book. With that said, I hope that you learned something about 401ks with this video. If I said anything that you found surprising or you didn't know about 401ks, leave it in the comments. I read and respond to all of them. And also, if you think there's anything I'd missed, I also would like to see that in the comments. With that said, I hope you enjoyed this video. If you did, make sure to leave a like. And if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.